At 9:30 in the morning, the opening bell rang on Wall Street, and for the men running Night Capital, it was supposed to be another routine trading day, another steady stream of orders flowing through systems they had trusted for years, another quiet reminder that they stood at the center of American finance. By 10:15, that confidence had turned into disbelief, because the firm was losing nearly $10 million every single minute, and no one in the room could immediately explain why. In less than 45 minutes, approximately $460 million would disappear, and within days, nearly $1.7 billion in market value would be erased. There were no hackers forcing their way into the system, no global market collapse, no reckless trader making unauthorized bets, just a single line of code that nobody checked. And what makes this story even harder to accept is that the flaw had technically been addressed before. It was not supposed to activate. It was not supposed to be there at all. So how does a billion-dollar Wall Street firm begin to unravel because of a piece of software that should have been harmless? How does a company that executed roughly 1 out of every 5 trades on the New York Stock Exchange, trusted by pension funds, retirement accounts, and everyday investors across America, watch its foundation crack in under an hour? The answer begins the night before, with a routine software update tied to a new exchange program known as the Retail Liquidity Program, designed to improve pricing for small investors. Engineers worked late, deploying updated code across 8 production servers, confident the system was ready. 7 servers were successfully updated. 1 was not. That one machine retained an older testing function originally written years earlier, something internal engineers had used in controlled environments but never intended for live markets. According to findings later published by federal regulators, when the market opened on August 1, 2012, the newly deployed software triggered that outdated function on the lone unpatched server, sending millions of unintended orders into the market in a matter of minutes. The system began buying high and selling low across more than 100 stocks, generating enormous unintended positions and compounding losses faster than human oversight could respond. Traders and risk managers watched balances surge and collapse in real time, initially unsure whether they were facing a market anomaly, a cyber attack, or an internal malfunction. As the clock moved past 9:35, then 9:40, the scale of the damage became impossible to ignore. Losses were climbing by the tens of millions, and every passing second meant new trades, new exposure, and deeper financial wounds. Before we dive deeper, let us know in the comments where you're watching from. We'd love to hear from you, and don't forget to hit that subscribe button so you never miss any of our upcoming videos. What followed was a race against time inside one of the most technologically advanced trading firms in America, a race to isolate the malfunctioning server, to halt the flood of orders, and to preserve whatever capital remained. When the system was finally shut down around 10:15, the damage had already been done. Nearly $500 million in trading losses had accumulated in less than an hour, and the market's reaction over the next 2 days would push the total destruction of shareholder value to around $1.7 billion. For the executives at Night Capital, many of them veterans of decades in finance, the event was more than a technical failure. It was a profound breach of trust in their own safeguards. They had compliance departments, risk controls, experienced engineers, and layers of oversight. Yet a single overlooked deployment step, a single server that did not receive the new code, allowed an obsolete testing function to execute in live markets. Regulators would later find the firm and document how insufficient controls and inadequate verification procedures allowed erroneous orders to enter the market. Within days, Knight would be forced to secure emergency financing to survive, diluting shareholders and ultimately merging with another trading firm, effectively ending its independence. But in those first 45 minutes, none of that was yet written. There was only a clock ticking, screens flashing, and a realization spreading across the trading floor that something fundamental had gone wrong. And if a firm that large, that experienced, that embedded in the machinery of American finance could be shaken by one unchecked line of code, the question that lingers is not just how it happened, but how often we assume the systems around us are safe simply because they worked yesterday. If the collapse of Night Capital had been caused by a reckless trader or a global financial panic, the explanation would have been easier to accept. But this story forces a different set of questions, the kind that linger long after the screens go dark. Who deployed the code on the night of July 31st, 2012, believing everything was secure? Why wasn't it tested in a way that guaranteed all 8 servers were running the same version? And how did one outdated internal function, buried inside a single machine, wipe out 158 years of corporate legacy in less than an hour? What exactly triggered it at 9:30 that morning when the opening bell rang? Why couldn't Daniel Mercer's team shut it down immediately once the losses began stacking up at nearly $10 million a minute? And when nearly $460 million vanished in 45 minutes and $1.7 billion in market value evaporated over the following days, who ultimately paid the price? This was not just a glitch, not just a technical oversight. It was a chain reaction inside one of the most sophisticated trading operations in America. 7 servers were updated. 1 was left behind. That single difference turned a routine software rollout into a crisis that threatened the survival of the firm. Orders poured into the market, thousands per second, across more than 100 stocks, distorting prices and building massive unintended positions. Inside Knight's headquarters, experienced professionals struggled to diagnose whether they were facing a cyber attack, a market malfunction, or a catastrophic internal error. Every minute spent searching for answers meant more trades executed by the rogue function that was never meant to touch live markets. And by the time Daniel Mercer and his team understood that the problem was coming from their own system, from a server that had not received the correct update, the damage was already measured in hundreds of millions. The clock had moved from 9:30 to 9:45, then toward 10:15, and with each passing second the firm's credibility eroded alongside its capital. This was the moment when trust and process collided with reality, when assumption met exposure, and when the belief that everything had been handled gave way to a harsher truth. And by the time they realized what was happening, by the time they traced the abnormal orders back to that single untouched server, it was already too late. To understand how 45 minutes could erase nearly $1.7 billion in value and leave Daniel Mercer fighting for the survival of Knight Capital, you have to understand what the company represented before that morning. Knight Capital was not a flashy hedge fund chasing headlines, and it was not a speculative startup trying to disrupt Wall Street. It was something far more embedded in the system. If you traded stocks in 2012, there is a strong chance Knight handled your order. Roughly 1 out of every 5 trades on the New York Stock Exchange passed through its systems. Billions of shares moved across its servers each day. It was publicly traded, widely known within the industry, and regarded as one of the central pillars of modern market making. For pension funds in Florida, retirement accounts in Ohio, and brokerage clients across Texas and California, Knight Capital was invisible but essential infrastructure. It stood between buyers and sellers, stepping in to provide liquidity so that markets functioned smoothly. For decades, firms like Knight operated in an environment defined by human judgment. In the 1980s and 1990s, trading floors were loud and physical, filled with brokers making split-second decisions face-to-face. But by the time Daniel Mercer rose to lead Knight Capital, that world had transformed. The shouting had been replaced by server racks. The hand signals had been replaced by algorithms. Orders that once took seconds or minutes to execute were now completed in microseconds. The competition was no longer about who could read a crowd best. It was about who could process data fastest. Knight adapted aggressively to that shift. It invested heavily in automated systems, routing technology, and complex software designed to analyze and respond to market conditions faster than any human could. Speed became currency. Reliability became identity. By 2012, high-frequency trading firms were engaged in what many insiders described as an arms race. Companies placed servers physically closer to exchange data centers to shave off fractions of a millisecond. Engineers optimized code to reduce latency by microscopic margins. The difference between profit and loss could be measured in thousandths of a second. Daniel Mercer understood that if Knight Capital failed to compete at that level, it risked being marginalized. So when the New York Stock Exchange introduced the Retail Liquidity Program, offering new opportunities to capture order flow from everyday investors, Knight moved quickly. Participation required new software, new configurations, and new deployments across its trading infrastructure. It was another step in staying competitive, another upgrade in a world where standing still meant falling behind. Inside the firm, this push towards speed and automation was seen as necessary evolution. Knight had weathered the dot-com collapse and the 2008 financial crisis. It had built a reputation for stability and operational competence. That confidence, reinforced by years of success, made the July 31st deployment feel routine rather than risky. 8 servers, 1 update, a new trading flag to activate participation in the exchange program. 7 were updated successfully. 1 was left unchanged. No one sounded an alarm. No one believed a single machine out of 8 could threaten a company that handled 1 in 5 NYSE trades. But in a market driven by software acting in microseconds, consistency across systems is everything. A single deviation can multiply faster than any human response. And the very environment that pushed Knight Capital to prioritize speed, efficiency, and rapid deployment would prove to be the condition that amplified its smallest oversight. That race towards speed, the same race that had elevated Knight into the upper tier of Wall Street's market makers, would become its undoing. On the evening of July 31st, 2012, while most of Manhattan was winding down, a small group of engineers inside Knight Capital's offices prepared for what was supposed to be a routine update. Daniel Mercer had approved participation in the New York Stock Exchange's retail liquidity program, and that required new software to be deployed across the firm's trading infrastructure. 8 production servers powered the system that executed roughly 1 out of every 5 NYSE trades. All 8 needed the update before the opening bell. The process, on paper, was straightforward. Install the new code, verify activation, prepare for the next morning. 7 servers were updated successfully. 1 was not. There was no alert flashing across a dashboard. No automated warning. No failure message. Just silence. The team believed the rollout was complete. What they did not realize was that Server 8 still contained an old internal testing function from years earlier, a function engineers had once used in controlled environments and never intended for live trading. Its name was PowerPeg. It had remained dormant, harmless as long as it was never triggered. But the new software reused a specific flag, and on that single untouched server, that flag pointed not to the new retail liquidity logic, but to PowerPeg. The stage was set, and when markets opened the next morning, PowerPeg woke up. At 9:30 a.m. on August 1st, the opening bell rang and Knight Capital's systems came alive. Orders began flowing through all 8 servers simultaneously. On 7 of them, the new program functioned as designed. On Server 8, PowerPeg began firing instructions into the market at extraordinary speed. 9:30 a.m., market opens. Within seconds, abnormal trades started appearing. 9:31. Internal systems showed roughly $10 million in losses accumulating. The algorithm on Server 8 was aggressively buying shares at rising prices and then selling them at lower prices, locking in losses each time. 9:35. The losses had reportedly surged past $100 million. The trades were not isolated to a single stock. They spanned more than 100 companies. The system was sending millions of orders, distorting prices, and building unintended positions faster than risk managers could assess them. 9:45. Losses approached $300 million. This was not one bad trade placed by a reckless individual. It was thousands of trades per second, executed automatically, repeating the same destructive pattern again and again. Daniel Mercer's team watched the numbers escalate, trying to diagnose whether they were facing a cyber attack, a market malfunction, or a catastrophic internal error. Engineers traced the activity, searching for the source while the clock continued to move. Every passing second meant more capital drained from the firm's balance sheet. And here is what made it worse. They could not immediately shut it down. The complexity that allowed Knight Capital to operate at high speed now slowed its response. Identifying the rogue server required precious minutes. Those minutes cost hundreds of millions of dollars. By the time the malfunctioning system was finally halted around 10:15 a.m., approximately $460 million had been lost in just 45 minutes. As the reality settled in, the atmosphere inside Knight Capital shifted from urgency to controlled crisis. Phones continued ringing as counterparties demanded explanations. Risk managers recalculated exposures again and again, hoping the numbers would somehow stabilize. Daniel Mercer convened emergency calls with senior leadership, legal counsel, and technology heads. The question was no longer whether the loss was real. It was how far the damage would spread. Traders who had built their careers on measured risk now faced a loss that had accumulated in less than an hour. The psychological weight was immense. Some feared regulatory consequences. Others feared client withdrawals. For a brief window that morning, there was still uncertainty about whether outside forces had contributed. But once engineers confirmed that power peg on server 8 had been triggered by the reused code flag, the uncomfortable truth settled over the room. This was internal. There was no external attacker to blame, no exchange malfunction to point toward. The failure originated inside Knight's own infrastructure. Yet, even with that clarity, the hardest part remained ahead. Stopping the malfunction had prevented further damage, but reversing the losses was impossible. Identifying the source had been critical, but it was only half the problem. In the days that followed, investigators dissected the chain of decisions that led to the event. The findings were stark. The code flag used to activate the new retail liquidity program logic had also been linked to the outdated power peg function. That function, written years earlier for testing, had never been fully removed from every server. When Server 8 missed the July 31st update, it retained the old mapping. When the market opened, the reused flag triggered the wrong logic. There was no malicious intent, no dramatic betrayal. It was a failure of process. They trusted the deployment process. They never verified it. 8 servers should have been aligned before live trading began. One was not. In a world where automated systems operate thousands of times per second, that single inconsistency proved devastating. Regulators later concluded that Knight lacked adequate safeguards to prevent erroneous orders from entering the market. For a firm that prided itself on reliability, the conclusion was sobering. Trust did not equal verification. Procedure without confirmation became exposure. But while internal reviews examined what went wrong technically, the broader market was already delivering its verdict. Knight Capital's stock chart told the story in brutal clarity. Within 2 trading days, shares fell more than 70%. Approximately $1.7 billion in market value vanished. Investors questioned whether the firm could absorb the $460 million hit without breaching capital requirements. Clients began rerouting order flow to competitors. Liquidity, once abundant, tightened. Emergency meetings filled Daniel Mercer's schedule as the leadership team evaluated cash reserves and financing options. In finance, perception kills faster than losses. Even if Knight could technically survive the immediate hit, it needed counterparties to believe in its stability. Doubt alone could push it over the edge. Analysts debated openly whether the firm would need outside capital to remain solvent. The conversation shifted from operational error to existential threat. Knight did not just need to stop the bleeding caused by power peg. It needed to restore trust in a market that had already begun pulling away. And here is what made it worse. Even after shutting down Server 8 at 10:15 that morning, they could not shut down the consequences. The trades had been executed. The losses were locked in. The headlines were spreading. In under 45 minutes, a routine software deployment had triggered a chain reaction that no executive order could reverse. Knight Capital did not just face a technical problem. It faced a crisis of survival. Within 48 hours of that Wednesday morning, Daniel Mercer and the board of Knight Capital faced a decision that would determine whether the firm would survive at all. The roughly $460 million lost in 45 minutes had carved a hole in the company's balance sheet large enough to threaten regulatory capital requirements. Counterparties were cautious. Clients were rerouting orders. The stock had fallen more than 70%, erasing about $1.7 billion in value. Behind closed doors, emergency negotiations began. Knight needed approximately $400 million in fresh capital to stabilize operations and reassure the market that it could meet its obligations. Without that infusion, the firm risked unraveling completely. Investors understood the leverage they held. The capital came with terms that diluted existing shareholders and reshaped control. It was a rescue, but not a victory. It bought time, restored a measure of confidence, and prevented immediate collapse. Yet it also marked the end of Knight Capital as it had existed before August 1st. In the months that followed, the firm agreed to merge with GetCo, another trading company with deep technological roots. On paper, the transaction preserved operations and retained many employees. Daniel Mercer stepped aside, and leadership transitioned under new ownership. The company survived on paper. But the night you knew, the independent market-making giant that once handled 1 in 5 trades on the New York Stock Exchange was gone. Its identity had been absorbed, its reputation altered permanently by a 45-minute window that no one could forget. And then there was the detail that lingered long after the financial terms were settled. The function that triggered the collapse, PowerPeg, had not been newly written in 2012. It had been part of the system since 2003, created years earlier for testing and never fully removed. For nearly a decade, it sat quietly inside the infrastructure of one of America's largest trading firms. It did nothing, caused no harm, drew no attention, until the night 7 servers were updated and 1 was left behind. For nearly a decade, it waited. When people look back at what happened to Knight Capital on August 1st, 2012, they often search for a villain. They expect greed, deception, or criminal intent to sit at the center of a loss that reached $460 million in 45 minutes and erased roughly $1.7 billion in market value within days. But Knight did not collapse because of greed. It did not collapse because of fraud. It did not collapse because of crime. Daniel Mercer did not authorize a reckless gamble. No trader placed an unauthorized bet. No hacker forced his way into the system. Knight Capital collapsed because someone assumed the system was fine. 7 servers were updated. 1 was not. The process appeared complete. The checklist felt routine. In an organization that executed 1 in 5 trades on the New York Stock Exchange, confidence in procedure had become second nature. But confidence without verification left a gap, and in a market driven by automated decisions measured in microseconds, that gap widened faster than anyone could respond. PowerPeg had been written in 2003, a harmless internal testing function that should have been retired entirely. Instead, it remained dormant, buried in Server 8. When the reused code flag triggered it at 9:30 a.m., the system did exactly what it had been programmed to do years earlier. It bought high. It sold low. It repeated the pattern thousands of times per second. The modern financial system amplified that behavior instantly. In a world run by algorithms, small mistakes do not stay small. They compound. They accelerate. They execute without hesitation. The same technology that allowed Knight Capital to compete at the highest level became the mechanism that magnified its oversight. The race towards speed that once defined its success exposed its vulnerability. And so we return to the clock. 9:30 a.m. The opening bell. 10:15 a.m. Nearly $500 million gone. 45 minutes. That was all it took to erase 158 years of corporate legacy, to force emergency financing of roughly $400 million, to dilute ownership, and to push Knight into a merger with GetCo that ended its independence. The firm survived in name for a time, but the identity that Daniel Mercer had overseen was transformed permanently. The lesson is not limited to Wall Street. It applies to any system built on automation and trust in process. When we assume the system is fine because it worked yesterday, we overlook the possibility that something small and overlooked could already be in motion. 45 minutes changed Knight Capital forever. Every decision has a price. So after everything Daniel Mercer and Knight Capital went through on that August morning, after 45 minutes erased $460 million and nearly $1.7 billion in market value, after emergency negotiations secured roughly $400 million to keep the firm alive and the merger with GetCo closed the chapter on its independence, the question still lingers. Was this negligence, or was it bad luck amplified by technology? 7 servers were updated. 1 was not. A code flag was reused. PowerPeg, written back in 2003, was never fully removed. In a system executing thousands of trades per second, that was enough. Do you think Knight Capital failed because its controls were inadequate, or because modern markets move too fast for any system to be completely secure? Could something similar happen again in today's AI-driven trading environment? where algorithms are even more autonomous and interconnected than they were in 2012? Let me know in the comments. I read them, and I want to hear your perspective. And if you think what happened to Knight Capital was fast, wait until you hear about the trader who lost $6.5 billion in just a few weeks under circumstances that stunned the financial world. Subscribe for more stories about the moment everything changed, because as Knight Capital learned in 45 minutes, every decision has a price.